Hello and welcome to the first episode of the Escape Student Loan Debt podcast for the year 2026. We are opening up this year with actually a recording from the year 2025. If you all remember a few episodes back, we hosted my friend Jack Wang, where we talked about ways to increase the amount of aid or financial assistance that your child might be eligible for when they go to college. And I actually recorded an episode on his podcast, The Smart College Buyer, around that same time. We wanted to post a recording of that episode because I think there are some things in it that are, in some cases, reiterations of things that we've talked about on the podcast, but also a more broad conversation about how the college conversation informs the balance of your finances. So in the link or the episode show notes, we're going to put links to his podcast, his YouTube channel. He puts out a lot of great content if you have children that one day you are hoping to get into college, but also updated information as to borrowing limits and things like that from the One Big Beautiful Bill Act. I think it was a really good conversation that you all will enjoy. So after a brief sound effect, you'll hear my voice again from the Smart College Buyer podcast. I hope you find this conversation valuable. I think part of this conversation even trickles down to how you communicate with your children before college, because I think that when it comes to education, we have trouble having straightforward and forthcoming conversations about what reality is. So, for example, I will have a parent who wants to send their kids through private schools all the way up through college, which means that they have less money to save for their own retirement, which means they have less money to put into a 529 or an education savings vehicle. So they haven't saved much going up to school, almost with the assumption that that child is going to get a full ride somewhere. They don't get a full ride somewhere, and now not only does the child not have enough to go to school, but the parent doesn't really have any other resources to help them, besides taking out loans. And now they're not as prepared for retirement as they could be.
Welcome to the Smart College Buyer podcast. My mission is to help high school families pay for college without taking on a truckload of debt. Each episode, I'll share insights into college admissions, financial aid, payment strategies, and more, often with expert guests. I'm Jack Wang, your host. I started helping families after struggling to navigate the process myself for my sons. If I needed help, I knew others did too. Let's dive in. Hey everyone, welcome back to this episode of the Smart College Buyer podcast. As always, I'm your host, Jack Wang. And today I'm very excited to have a guest. And by the way, if you listen to this podcast, I always say I'm excited to have a guest, but because I am. I love talking to different people to bring information to you. But today I have a particular story about the guest. So today I'm speaking with Brenton Harrison. He is the founder of New Money, New Problems, a financial advisory firm serving the needs of first and second generation high income earners. He's been featured in publications such as Business Insider, USA Today, and Forbes, and named one of the top 100 advisors in the country and top advisors under 40 by Investopedia and Investment News. Brenton hosts the weekly New Money, New Problems podcast, of which I am a listener, on all things finance, and the bi-weekly Escape Student Loan Debt podcast for borrowers struggling with federal and private student loan debt. But what I think is most interesting is actually how we met. So I want to share the story with you. He and I met at a conference in New Orleans a couple of years ago, and he was one of the speakers at this conference, and I was sitting there dutifully taking notes. And he was talking about using podcasts as a marketing platform for advisors, for other individuals. But towards the end, he mentioned a couple things that are unique to the financial advisor business, which really got my juices flowing and really caught my attention. And so thank you, Brenton, for accommodating me, because I got to tell you, folks, I was peppering him with questions nonstop, both towards the end of the session as well as after the session. And I really, really appreciate that. So Brenton, thank you so much for sharing all that information that I learned from you at FinCon in 23, but also for all the help that you give clients. And by the way, Brenton, you can follow him on LinkedIn. He posts some great content, not only from his podcast, but also other articles and stuff talking about student loans and personal finance. So with that, Brenton, welcome.
Thank you for having me. You know, I've appreciated getting to know you, and definitely the way that we met was unique. I think that one of the most important things you can do in this space is be willing to help and receive help. So I'm glad we connected.
Yeah, absolutely. And I should also say that Brenton is based out of Nashville, Tennessee, but you work with families all over the country.
Yep.
Right. So first things first, actually, I just want to talk a little bit about your background and your advisory firm practice. But for those who may not understand the reference, you want to just talk a little bit about the name New Money, New Problems?
So choosing that name was very intentional. It was designed to drive away as many people, if not more people, than it attracts. To me, I think that you should be very specific in reaching out to a target audience and letting them know what you're about on the front end. So, you know, I could have done Harrison Financial Services, but the fact of the matter is the majority of the people with whom I work, they are 80s and 90s babies who loved hip hop. So to me, when you talk about more money, more problems, it is an immediately recognizable reference that if you're somebody who is looking for the more traditional buttoned up advisor, you either don't get it or you think that that name isn't serious enough to trust your money with that person. But if you're a person who not only grew up in that era, but also like actually has new problems because you have new money, it's just kind of a tongue-in-cheek way to let them know, like, I'm your people.
Yeah, absolutely. And it's funny you mentioned about the traditional buttoned up advisor, because, you know, even to this day, I'll go to different like networking events or something, and you can always tell who the financial advisors and lawyers are because they're the only ones wearing suits, right? So still, and you got the traditional and the tie. I know I still have sport coats. I think I got rid of all my suits and most of my ties years ago. So anyway, so today I want to just have you talk about and share tips with with the listeners around the big, beautiful bill, how it impacts, in particular, student loan borrowers, you know, those already in college or those already graduated from college. But you also deal with other aspects of finance, not just paying for college, not just student loans. So Brenton, I'm going to ask you, and this is going to sound really kind of silly, but how about a brief synopsis of the 870 pages that was the Big Beautiful Bill Act?
You know, I would say that the Big Beautiful Bill Act has made it so that you really can't ignore tax planning. I think that prior to really the first Trump administration, the way that we handled our taxes had not changed in a radical way for a very long time. So, you know, maybe there will be some slight increases in the percentages that you pay, but the structure of how you file your taxes was not that different. This is now the second time that the Trump administration has released something that says, oh no, like you really, really have to pay attention. So for example, there are impacts for someone who may live in a state that has a really high state income tax. Well, prior to the first legislation that the Trump administration released, if you were in one of those states, one of the biggest tax deductions that you had at the federal level were the state taxes that you paid at the local level. So the government wants to make sure they don't tax you twice, or at least they did. So if you had already paid $30,000, $40,000 worth of taxes at the state or local level, you would get a credit for that at the federal level, or a deduction would be a better use of the term. Well, now there is a limitation for how much you can claim at the state and local level, but there are ways around it, right? So for a very few number of years, you can claim up to $40,000 of state and local taxes. That's not just income tax, that's also property tax if you own a home. But after a certain number of years, that goes down to $10,000. But You also, if you're a business owner, can have something called pass-through entity taxation, where you structure your business in a certain type of way so that you pay all of your state and local taxes at the business level, and it gets around that exception at the income individual level. That's literally just one example of, hey, I have to have a strategy for this. It touches every part of my finances, and depending on your industry or your circumstance, it may be different. For example, if you are someone who works overtime or gets tips, then there are ways that you can have a certain amount of those tips excluded from your federal income. So there's a lot in the bill. I would say the best way to summarize it is you need to, if you didn't already, have a working knowledge of tax and at least be dangerous enough to know when you shouldn't be doing the TurboTax, right? Like, hey, I actually need to talk to a tax professional because the wrong move could either cost me a lot of money or I missed out on saving a lot of money.
Right. Yeah. I mean, and not everybody is a tax professional, right? And you're right, because I've run into a lot of people who use TurboTax or the H&R Block software. And so, yes, it does make filing of taxes very easy, but it's missing the tax planning part, right? So people might miss out on this stuff, like you said. Brenton, let me ask you to talk a little bit about the provisions in the bill that relate to student loans and how that's changing for student loan borrowers.
Yeah, so I'll actually work backwards from people who have already finished school, because there's a great many differences as compared to what it was before this act was passed. So there are two key dates for people who have already graduated and are in repayment. The first of those dates is July 1st, 2026. And that's a really important date for a couple of reasons. The first reason is, after that date, in terms of income-driven repayment plans, and if your listeners aren't familiar, an income-driven repayment plan is a type of payment plan that allows you to pay based on a percentage of your income rather than what's actually needed to pay off the loan in full in a given period of time. So there's all these different types of calculations depending on the plan that you've chosen. And right now there are a bunch of options. There's income contingent repayment. There's the old and new version of income-based repayment. There's the pay-as-you-earn plan. Can't really use the save plan, but it's available. But after July 1st, 2026, there will just be two options: income-based repayment and repayment assistance plan, if you have not already put yourself on another plan prior to that date. So if you're on the pay-as-you-earn plan before July 1st, 2026, you'll get a small reprieve. But if you haven't taken any steps before July 1st, 2026, you'll only have those two options. The other group that's really relevant for July 1st, 2026 are Parent Plus borrowers, because Parent Plus loans are very, very tricky. And if you do not take action to structure your Parent Plus loan in a particular way by July 1st, 2026, you will lose the option of pursuing income-driven repayment, which also means you lose the option of public service loan forgiveness. So an extremely important date, July 1st, 2026. The second date that's important is July 1st, 2028, because by that date, even if you went into one of the plans that were grandfathered, like income contingent repayment, pay as you earn, those plans will be whittled down to the two that I mentioned, income-based repayment and repayment assistance plan. And after that date, that's literally it. There's no grandfathering in. The other plans will be done away with, and that's what you have moving forward. So because those two plans that will remain could have a radically higher payment than what's available right now, you need to do some calculations even now to see the potential impact on your finances.
Yeah, so and that's definitely something I want to talk about, right? It's really the impact on the rest of the finances. So, but before we get to that, so that was a great breakdown of those who have graduated, right, either undergrad or graduate, and now are in repayment. I'm going to ask you to step into the very complicated waters of what happens if the student is currently in college or graduate school now.
Yeah.
Because I know that that's a whole, I mean, you know, the outcomes are sort of similar in terms of what's going to be available going forward, but because they're in school now, it's a much more jumbled mess.
I'll give you some specific examples. let's say that I am a parent and I'm borrowing for my child. So I'm borrowing Parent Plus loans and my child is a sophomore. Well, anything that I've borrowed up to this date, if I take action by July 1st, 2026, I can position those loans to be eligible for income-based repayment. And if I'm a public servant, I can pursue public service loan forgiveness for those loans. I can have them forgiven after 10 years worth of payments, right? Anything before July 1st, 2026. But they're a sophomore, right? So maybe for that last year or that last year and a half after July 1st, 2026, they still need aid. And I was going to borrow more money for them to go to school. Well, now I have to be very careful because the loans that I borrow after that date will not be eligible for income-driven repayment or public service loan forgiveness. So I'm going to actually have to pay that loan back in full. So it becomes very important to calculate, can you actually repay that loan in full, right? And can you do that while also having to do an income-driven repayment plan for the loans that you took out before July 1st, 2026? So it could radically alter the decisions that a parent or a current student makes in terms of how they pursue their degree. Another example, if I am going to be in school and I know that there's the potential that I have to borrow money that now has to be repaid, I'm not going to have it forgiven. It may change the structure of how you pursue your degree. Maybe instead of doing all of your generals at your college of choice, you do them at a local community college, or you do them in the summer and you save your, education major specific courses for that institution of your choice. It's going to have a big impact in terms of trying to lower the cost of borrowing before you leave, because if not structured appropriately, it could truly be a career and finance altering decision.
Yeah, it's scary about these big decisions because we're talking about big dollars, right? So I think nationally there's something like 1.6 trillion student debt. But also that number gets added to every day because families, right, as students graduate high school, going to college, and families are borrowing. So it's a big problem. So, but I want to get back to what you said earlier. So oftentimes when I work with folks, initially they think about their finances in silos, right? Which is probably something you run into also. Like, this is college money, this is retirement money, this is like vacation money, this is blah, blah, blah. And yeah, it might be helpful to keep track of that, but the reality is that they all are interconnected, right? Because after all, there's only so much money to go around. So with the changes in the student loans, what are some of the things that people have to think about that maybe they don't realize because this is so new, in terms of how it's going to impact the rest of their finances?
Yeah, you use the term silos. I think that's a great term. I often say that nothing that you do financially happens in a vacuum. So anything that you do in one area is going to impact another area. I think part of this conversation even trickles down to how you communicate with your children before college. Because I think that when it comes to education, we have trouble having straightforward and forthcoming conversations about what reality is. So, for example, I will have a parent who wants to send their kids through private schools all the way up through college, which means that they have less money to save for their own retirement, which means they have less money to put into a 529 or an education savings vehicle. So they haven't saved much going up to school, almost with the assumption that that child is going to get a full ride somewhere. They don't get a full ride somewhere. And now not only does the child not have enough to go to school, but the parent doesn't really have any other resources to help them, besides taking out loans. And now they're not as prepared for retirement as they could be. So to me, I think that you kind of have to, as best as you can, chart the course for your life and be open and honest about what that means, depending on your decision. So, for example, my child may go through private school all the way through. That may mean that I am going to have to continue to cash flow his college because I have not been able to put as much aside in a 529. And that's fine as long as I am aware of the consequences of my decision, right? If I decide that I am going to cash flow all the way through, then it may mean that I'm not able to put as much in my retirement account. How am I going to adjust for that? So to me, being open and honest with yourself, having people in your corner who are open and honest with you as well can help you structure your finances based on what's important to you, as opposed to just assuming that everything will work out.
Yeah, that's a great point. And actually on that last point right there where you said, I get a lot of families who don't think about this in advance, and they sort of just assume that everything's going to work out because they don't necessarily understand the system. Sometimes parents think that the way that loans and aid works is still the same from when they went to college, 20, 30 years ago. So I think it's a great several points you brought up about thinking about, the impact on other finances. What would you say would be the number one thing that families really need to think about this, right? Whether it's before they're in college or let's say their students already graduated and now they're in repayment, because obviously it touches everything else, but is there a particular area where they should look at first to start to figure this out?
Yeah, to me, I think that the better prepared financially a parent is by the time their child gets to college, the better the child will be, regardless of how getting through college actually ends up coming to fruition. So whether you're helping them borrow, whether you're cash flowing, the better prepared you are financially, the better the child will be. So to me, for my clients, that typically means we focus on liquidity. It means that if you're in a position where your child is going to get to school before you are 59 and a half, it is actually more beneficial in many scenarios for you to prioritize like non-qualified investments, which is just another way of saying not a retirement investment. So we focus on building up their brokerage investments. We focus on, for people for whom it's appropriate, permanent life insurance, tools that can be accessed regardless of age, so that by the time they get to school, they have as many options as possible in terms of how they assist their child, right? If you are going to give them money for tuition, maybe you would consider instead establishing residence for that child, right? Let's buy them a condo and you have two children who are going to school in the same area, or you can rent out the other room, which is something that one of my best friends did in college, right? His parents they had three boys going to the same school. They bought 3 houses in Huntsville, Alabama. There were 3-bedroom houses. Their sons lived in each of the houses and they rented out the other 2 bedrooms in each house. So now you have an asset that you can pass on to each of your boys. They each have a home in their name by the time they graduate, and you've been collecting years worth of rent for 6 tenants across those 3 houses. Those are the types of things where maybe you don't pursue it exactly that same way, but I'd love for you to have that option if we're going to have some foreplanning.
I love that example. And actually, I think back to my own experience, actually, when I went to college over 30 years ago. And I remember my parents and I actually looked at buying a condo. Of course, back then, prices of real estate was a lot different. And I'll never forget this because there was a condo building that, I don't know if it was going through foreclosure or something like that. Like we had nothing to do with it. But then I remember like this 2-bedroom condo being listed for like $25,000. And, of course, the thing must be worth a ton now. But looking back, like I kind of kicked myself or, my parents for like not pulling the trigger on that one. But anyway, oh well, spilled milk. But, it's interesting that you talk about the liquidity, because I think for so many families and other financial advisors, quite frankly, their automatic assumption is when they save for college, it's got to go into 529. Now, again, hey, folks, again, this is not investment advice, right, for educational purposes only. But it doesn't sound like for you, Brenton, that's necessarily default choice. So maybe talk a little bit about that a little bit more. So maybe when should a family think about a 529 as opposed to using one of the other strategies you just talked about?
Well, some of it is specific to my audience, hence the name New Money, New Problems. I am working with people who are typically behind in their planning in several areas by the time they reach me. They are not meeting, their insurance needs. They haven't established an estate plan. Maybe, they have a decent retirement plan, but they have no non-qualified investments. So to me, when I have a family in front of me who may earn a great income, but they haven't established some key elements of what I consider a balanced financial plan, my preference is to establish vehicles that have the most flexibility. So for example, if I see someone who has a retirement account, they have cash savings, but no non-qualified investments, to me, putting a lot of money into a 529 is imbalanced, right? You have no assets that have the opportunity to earn a rate of return that you can access before 59 and a half, or that don't have restrictions to them like a 529. So I'm not anti-529, I'm anti-imbalance. So if I have someone who is meeting all the metrics, they do have a healthy retirement account, they're insured, they have their estate planning taken care of, they're contributing to non-qualified investments as well, then I'm fine with them funding or overfunding a 529. But to me, I just think many times people fool themselves, again, right, going back to honest conversations, into thinking that they're going to be able to get their kid through college because they put $100 a month into a 529 plan. That's just not the case for 99% of the colleges that are out there.
Right. I mean, which would be great, right? If we could all do that and just, $100 a month. Hey, I can swing that, and then college is paid for. Yeah. That makes sense. That makes a ton of sense. Now, let's switch gears a little bit to those who are already in repayment. And as a result of the big, beautiful bill, it is likely, not guaranteed, but it is likely that the payments for a lot of folks are going to go up, right? So now their payments were X dollars. Now it's going to move up to Y dollars. What are some tips that you would share with those folks who may be looking at a substantially higher payment on their student loan?
Understanding the mechanics of how payments are calculated is of utmost importance, because if you understand the mechanics, you can use them to your benefit to not only lower your payment, but possibly even benefit other areas of your finances as well. So as an example, the payment plans that fall under that income driven repayment plan umbrella, they typically are going to calculate your income using your adjusted gross income. And adjusted gross income is just a tax form or tax term that means if I take my total income before I find my adjusted gross income, there's all of these deductions that I can use to lower the income on which I pay taxes. So for example, things that will lower your taxable income down to that adjusted gross income level are things like the amount you put into pre-tax retirement plans, your IRAs, your 401ks, your 457 plans, your 403bs. If you're a business owner, it's half of the self-employment taxes. So it actually encourages, a bit of entrepreneurship. It is the money that you put into your health savings accounts, your flex spending accounts, your dependent flex spending accounts. All of these are things that benefit you, right? Putting more money into your retirement plan can lower your adjusted gross income and lower your student loan payment. So if you understand that, you can use it to your advantage and, increase your retirement savings or put aside money pre-tax for things you already pay for in a way that benefits your student loan payment. There's also different techniques that you can use in a pinch to understand how to utilize the legislation in a way that if there's something that occurs in your life, you can immediately adjust your student loan payment. So here's an example. When you have some of those plans, the payment is going to be calculated and considers the number of people in your household. And if you have more people in your household at the same income, you'll have a lower payment than someone who makes the same but has less people in their household. So if I am in a relationship and my partner becomes pregnant with child, well, I may think, okay, once this child is born, I can call my loan servicer and I can say, hey, we've gone from a family of 2 to a family of 3, so lower my student loan payment accordingly. But the legislation actually says that when you are pregnant with child and the child is due to be born in the same calendar year, in terms of federal student loans, they already exist. So when pregnant, you can call your student loan servicer and say, lower my student loan payment, right? That would be one kind of like really obscure example of knowing how the rules are written and using them to your advantage to lower your payment.
Now, by the way, I just want to be clear. So you're not necessarily giving the advice to your clients like, hey, you need to have a kid now, right? To lower your student loan, right? We're not, I don't know how the SEC or other regulatory bodies would view that.
Yeah, no, definitely. And
but it's a good obscure
and trust
point.
me, the child is going to cost more than whatever you saved on the student loan payment. But it's an example of knowing the rules. Here's another one. We have people who, will be terminated or laid off, or maybe they'll just decide that they're going to take a 2-month break between their last job and the next job. Well, you can contact your student loan servicer as frequently as benefits you when it comes to adjusting your payment. So you don't know what could happen with that next job. Maybe something happens in the next 2 months and you weren't going to end up working there. But right now you have $0 worth of income. So you can call your student loan servicer and ask them to reset your payments for the next 12 months based on the income you have now, which is $0. Now, there are some of those plans that are still going to have a minimum payment, but there are also others that will allow you to not only have that $0 payment for the next 12 months, they'll still give you credit towards forgiveness as if you were actually paying. So you definitely want to make sure that you're not doing anything illegal. But there are so many loopholes that are allowable within the way those rules are written that can help you when you need it.
Yeah, and that's great. And that sort of gets back to what you said earlier, some of those examples about tax planning, right? So this really goes beyond just pushing a bunch of buttons in TurboTax software or whatever. It's really thinking about some of these loopholes, like you said, but also I know in situations if parents file taxes, married filing separately for what, part of, to lower their student loan payment, but who should claim the kid, right? Like whether it's on this parent or that parent and things like that. So there's a lot to it. So Brenton, I really appreciate this conversation. I know that we can go forever on this because there's so many different aspects that we could talk about. But as one last final question, what would be your number one tip, if we haven't covered already, for either those who are about to send their kid to college or those in repayment, that number one tip, like, hey, start with this or look at this first?
If you are about to go to school or your child is about to go to school, my number one tip is a little off the wall. I would want you to have, regardless of who you serve, I was going to say come to Jesus, but let's just an open and honest conversation with yourself or with someone else about your intended career path. And this is where I talk about us being unwilling to have transparent conversations. If my child said that they wanted to specialize in education, I would absolutely encourage them to pursue that. But if they said that they were going to go to a school and borrow $150,000 to do it, I would have an honest conversation that says, hey, let's look at the average income for this career and let's talk about whether it's a good idea to go to this institution to pursue something that's going to earn you, if you earn an average income, an amount that's going to make it very difficult to repay this debt. Might it be better to pursue this institution or this institution? And no parent wants to discourage their child from their school of choice. But again, if a child is able to do all the things that are required to get into a school, they're able to sit through an open conversation with their parents and learn some hard truths about what it will look like in repayment. So I would want to have some more insight into what do you want to pursue? What are you interested in? Are there ways to lower the cost of this? Are you willing to go to community college for a year or two, or go to community college in the summer or something of that nature? That's what I would encourage people to do if they're about to go. If you're in repayment, I would want you to look at the numbers and determine, am I going to have these student loans forgiven or am I going to have to pay them off in full? Because figuring that out is going to chart the next long stretch of your life, and it's going to change the strategies that you bring to that student debt. If I'm going to have my student loans forgiven, I want to know those rules backwards and forwards so I can have them forgiven after paying the absolute least amount of money possible. But if I am going to have to pay it off, I also want to pay the least amount of money possible in a way that doesn't keep me from addressing other elements of my finances. That sounds contradictory. It's not. I may be able to pay that student loan off in 5 years for the least amount of money, but if it cost me so much that I wasn't able to put a dime in my retirement accounts, that's too aggressive. So what is that middle, the middle of the road that says I'm addressing this, but I'm not treating it as if it is, to your question or to your phrasing, in a silo. It touches everything else in your finances.
Those are great tips. Thank you so much. Yeah, it makes a lot of sense, right? You got to do some planning and think about this and think about the long-term implications in both of those scenarios. So Brenton Harrison of New Money, New Problems, thank you so much. It's awesome to see you, and I look forward to seeing you at the conference coming up and talking more about these really important issues and sharing them with both of our audiences. And thank you, dear listener, for listening to the Smart College Buyer podcast. Please make sure you subscribe to the podcast and connect with me on social media. I do post some other videos and share articles with this information about these topics and others. So as always, folks, stay safe, stay healthy, and I'll see you next time. Thanks for listening to the Smart College Buyer podcast. I hope you found the information useful for your family. Follow me on LinkedIn for more episodes, videos, and tips. The link is in the show notes. Remember, you can spend time now to plan and strategize, or you can spend more money later. Success in college admissions and financial aid isn't about luck. It's about being intentional. I'm here to help you every step of the way.